here at Modular, we believe that sustainability and digital assets are two of the dominant investment themes for the coming decade, and that they need to be compatible. At the moment, there's plenty of evidence that in both investment and adoption of blockchain technology, very few people are taking into consideration ESG characteristics. So we're developing a sustainable blockchain strategy which integrates proprietary ESG metrics into our investment methodology and focuses on investment in smart contract platforms, which are the operating systems upon which the blockchain-based applications of the future will be built. It's our belief that usage of or adoption, the integration of these ESG metrics will add value to the strategy and will enable us to outperform the asset class. So we're running this with our own money at the moment, and we may open it up to the future to institutional investors.
You must admit, though, Matt, you're facing an uphill battle here, because it's not just the energy usage issue, it's the anonymity of crypto. It means that there is this perception that it provides a safe space for criminal activity, governance side as well. There's a lack of a central register. Where are you in terms of hearts and minds perceptions amongst institutional investors?
Let's start off with the energy piece, just as an example, and an example of why we think that this is important and things will change. Last month, Adidas announced their foray into the metaverse with the minting of NFTs. So they'll be launching their brand into a new realm. Those NFTs are going to be minted on the Ethereum blockchain. Now, that selection choice of the Ethereum blockchain by Adidas is an interesting one from an ESG perspective. One transaction on the Ethereum blockchain uses something like 8 million times as much energy as a similar transaction on the Algorand blockchain. So they could have made the decision to launch their NFTs on Algorand. Now, Adidas is a company which generally performs well when it comes to ESG metrics versus its peer group. But this decision, which, one transaction on Ethereum is the equivalent more or less to the manufacture of 20 cotton t-shirts, it appears that they may not have considered the selection of Ethereum for the basis for their NFTs in the way that they ought to and perhaps should be challenged on in future. And we think that this kind of discussion around adoption decisions when it comes to blockchain and cryptocurrencies will become more prevalent and will weigh in favor of our investment thesis. Not all blockchains are the same. So this kind of assumption that everything is like Bitcoin is incorrect. There are ESG-friendly decisions that people can make, and we analyze into those.
What about wealth inequality? You've mentioned this as something under the S part of ESG. How do you relate wealth inequality and I guess therefore trying to see a more equal distribution of that wealth when it comes to crypto in your fund?
Yeah, that's a really interesting question, because when you analyze a blockchain system, it's about mechanism, not management. And so the kind of metrics that you need to look at are different from what you would use when you're looking at a company. They're more akin to those that you would use when you're looking at an economy. So in an economy, you look maybe at a Gini coefficient. In the blockchain world, we are able to look into the distribution of wealth in any given cryptocurrency by looking at the distribution of assets across the wallets in that system. And that gives us the equivalent of a Gini coefficient. Our thesis is that the more wealth distribution there is within a system, within a particular cryptocurrency, the more stakeholders there are. That will lead to a broader interest in adoption and usage of that given blockchain, and that will be an indication for the future growth. So it will be good for our thesis. So using these kind of metrics, we actually add value to the investment strategy.